It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. The stock rally taking a breather as traders focus turns to Nvidia's earnings for a check on the resilience of the AI frenzy. A Bloomberg gauge of commodities easing from a 15-month high. We'll get the outlook for iron ore and coal prices with the CEO of India's biggest steelmaker, JSW, after fourth quarter profit tumbles 64%. Plus, succession plans in focus for major Middle East rivals with the Iranian president's death and ill health for the Saudi king. Let's get you to markets. Of course, stocks taking a breather, commods taking a breather. Avril Hong is on top of all of that. Avril.
Indeed, Has. We're seeing Asia's stock market rally from yesterday, driven by the surge in commodities. Remember how gold and copper hit those record highs? Well, today that Asia stock rally has fizzled out, and we see how even though some of these commodities still sitting at the highest levels, they've pulled a bit lower. And in the markets, we're also seeing how investors are grappling with Fed speak about how Loretta Mester, especially, saying that 3 rate cuts this year might not be appropriate still. Now we're seeing the Hang Seng being driven lower. It is dragged today by the EV makers as Li Auto missed on earnings, and the Nikkei is the outlier today, helped along by insurers. In Japanese yields, the 10-year continues pushing towards that 1%. Dollar yen not helped by that, though. It's pretty much a dollar story. Let's flip the board and take you to South Korea, because as we wait for those Nvidia earnings, we want to focus on 2 of its suppliers in South Korea, SK Hynix and Samsung. As you know, SK Hynix, the smaller of the 2, is really outpacing in terms of its share gain this year versus Samsung because of its edge in the high bandwidth memory market. And I think investors have been concerned about that. To that end, we've seen today Samsung announcing that it's replacing the chief of its chips division. Flip the board again, because as you know, semiconductors in Asia, not just South Korea, have been seeing really strong demand. And we've seen how early trade data in the country shows those semiconductor exports, they surged 45% for the first 20 days of May. And this is leading the pack in the overall exports growth. This could go some ways in helping to make the case for a BOK that keeps things restrictive. Remember, it meets later this week. It's not expected to change on rates, though, Has.
Also paving the path, perhaps, for a stronger GDP print this year. Avril Hong, thank you. And we've been getting another raft of Federal Reserve speakers reiterating the central bank's wait-and-see approach on rates.
I was on the record before saying I was at the median, which was 3. The developments I've seen in the economy right now, I would not think that that's still appropriate because the inflation risks have moved up.
Higher than what people have known over the last decade, maybe back to where we were in the 1990s and 2000s, but we'll just have to see.
All right, our next guest says it's not a question of how many Fed rate cuts, but when. Let's bring in Mabruk Shetuan, head of global market strategy at Natixis Investment Managers, which handles more than $1 trillion in assets. Good to have you with us, and welcome to the city. We heard from the Fed speakers, no change, no more clarity than before. So when do you expect the first cut to be?
I think the best window for the Fed to introduce and to announce, an inflection in their monetary policy could be September. And there are, 2 key reasons for that. The first one is the Fed will have enough data to qualify, the progress made on the inflation front. And the second reason is the Jackson Hole Symposium. This symposium is usually taking place at the end of August, and this is the moment that all the central bankers are using to announce a new, let's say, inflection in their monetary policy. We have in memory what Mario Draghi said in 2014, introducing the QE for the ECB. So I think that Jay Powell will use this moment to say, okay, we are now at a moment where the U.S. economy needs the first rate cut. It doesn't mean that the Fed will continue to decline rates, FOMC after FOMC. We have, this election in the US, the calendar is a bit complicated in November. So the key question is when? September, and the second could be at the beginning of 2025.
The key question is also whether that cut in September that you're anticipating is enough to sustain the rally we're seeing in the markets right now.
It gives at least a good signal that the Fed is pragmatic. The Fed will not, will not stay in this situation with non-accommodative monetary policy. They are pragmatic in the sense that if they see any, let's say, negative development on the labor market, on the economy, they will start to ease, the financial conditions, which could be another, leg for the equity market to end the year with a positive score. So definitely the Fed could help.
So does it also necessarily mean that the dollar will weaken from September?
Yes and no. Yes, because if the tone of the Fed is, let's say, extremely accommodative, the dollar can weaken. However, we are not seeing any, the collapse of the U.S. economy. We are not seeing, a massive change in the monetary policy journey. So this is why we do believe that the Fed, the U.S. dollar will stay strong against all the currencies, against the euro, but also against, the emerging currencies as well.
Let's talk about how challenging it's been for investors in 2024. It's been tough to navigate. How do you craft a portfolio that is resilient and can withstand all the uncertainties we're talking about?
Well, we had the conviction at the beginning of the year that it was not the moment to leave in the equity market, because we have the conviction as well that the growth has not disappeared from the landscape. And if we look at the European numbers, for example, it illustrates quite well the situation. In the Eurozone, we could be positively surprised, and the first numbers that we had for the first quarter of this year for the GDP growth rate are beyond, the expectations of the consensus. So definitely we think that the mix inflation plus growth is positive for the earnings. So it's not the moment to leave.
So how does your portfolio look like, taking that into consideration?
We are overweighting the equity market. We are overweighting the U.S. equity market, still playing this growth story, this tech story, because it's very complicated to stay away from this market.
But where exactly in terms of sectors? We know that Max 7 technology has pretty much driven the rally.
Exactly.
Is that where you continue to see conviction?
Exactly. So we are still invest in this sector, but there are two other sectors in Europe that we do like. The first one is the banking sector, because with elevated interest rates, so this sector is still benefiting from this environment of elevated rates. And the second one is the energy sector. The energy sector is benefiting also from elevated oil prices, and we do not see any changes in this situation. Oil prices and energy prices will stay high for a long period of time, and this is benefiting from this energy sector. So definitely we do like, the combination of growth sector with the tech and value sectors with these two convictions, the banking sector and the energy one.
We have Asian central banks out with decision. We know that this is an environment where central banks are no longer synchronized. What opportunities do you see?
For the bond market, the central bank are extremely important, but there are. The bond market is definitely not performing this year, and this year could be another year with negative performance for the bond market. But it doesn't mean that there is nothing to do in this market. We do like the IG market. We do like the short durations, because we do at some point the central banks will deliver. They will cut their rates. The key question is when, of course, but definitely in the second half of the year, they will deliver, and we will see the short duration delivering performance in the diversified portfolio.
But how about in Asia? Where do you see the opportunities?
Well, Indonesia, as we are not, we're not really exposed, to this part of the world. But what we can say is, in Asia, I mean, the stories are different, or let's say different, because the central banks are tracking, I mean, different objectives. Some central banks are trying to stabilize, I mean, their currency. Other central banks are trying to preserve, I mean, their competitiveness. So, given the objective and the function reaction of all the central banks, I mean, there are, I mean, different, let's say, opportunities. And in Indonesia, we do see, I mean, the stabilization of rates so far. So this is not the moment to be exposed.
Mabruk, hang tight. Mabruk Shetuan of Natix's investment managers, he is sticking around. Well, still ahead this hour, Pictet Asset Management shares their tips on event-driven investing. Plus, the CEO of India's largest steelmaker will be joining us to discuss their growth strategy after a fourth quarter earnings miss. Keep it here with us. This is Bloomberg. Waiting on the Fed, waiting on NVIDIA. Asian markets taking a breather after 7 days of consecutive gains. Traders, of course, keeping an eye on NVIDIA later in the week, the last of the Mag 7 to report to see if gains are sustainable going forward. The Hang Seng down 2%, Kospi, TAIEX and the ASX 200 in the negative as well. Well, power transitions in the Middle East are in focus after the death of Iranian President Ibrahim Raisi. Meanwhile, in Saudi Arabia, King Salman's health is being closely watched as he receives treatment for lung inflammation. Bloomberg Horizon's Middle East and Africa anchor Jumana Besechi joins us from Dubai. Jumana, thank you for joining us. Let's start with Iran. What's the latest there?
Yes, well, the country has now officially entered into a period of mourning. It will last 5 days. A memorial service will be held later today for those who died in the accident, of course, including the President Raisi and the Foreign Affairs Minister, who also died in that helicopter crash. In terms of who takes over, we spoke about this yesterday. There is a procedure in place as per the Constitution. The first VP, Mohammad Mukbar, has now taken on presidential duties as an interim president. Ali Bagheri Khani will serve as foreign minister. But the Iranian state TV has announced that a presidential election will take place on June the 28th. Candidates now have to register their interest from May the 30th to June the 3rd. But of course, all of those candidates will have to go through a vetting process via the Guardian Council. And it is worth bearing in mind that back in 2021, when Raisi ran for president, he was the only person running because that Guardian Council vetted the candidates so strictly that in the end, Raisi had no one to run against. It will be interesting to see, of course, how this plays out in the course of the next few weeks. The hope, at least from some members of the public, is that someone more reformist or more centrist would put their name into the ring.
And Ju, what's the latest in Saudi Arabia, where succession is also top of mind?
Yes, I think we are closely monitoring the situation of His Majesty the King, King Salman. He is in his late 80s. He has suffered from bad health in the last couple of weeks. More recently, the last couple of days, he was admitted to the hospital for a lung inflammation. He's now in a hospital in Jeddah, not in the capital Riyadh. And of course, many well wishes from within the Saudi kingdom have started to come through, praying for the health of the king. But of course, this again sets into question the succession plans within Saudi Arabia. We know that the Crown Prince Mohammed bin Salman is poised to take over should the king come to pass. And what's notable is that the Crown Prince was supposed to be engaging in a foreign trip this week. He was supposed to be on his way to Japan. He cancelled that trip, which perhaps is a reflection of the state of King Salman's health. And so many people within the kingdom are keeping a close eye on how this is all going to play out, but also what it might mean for some of the bigger picture policy questions, including this much talked about Saudi-US defense deal and the eventual pathway for Saudi-Israel normalization.
Ju, thank you so much for that. Bloomberg Horizon's Middle East and Africa anchor Jumana Besechi. Well, for more on the geopolitical risks facing markets, let's bring back Mabruk Shetuan, Head of Global Market Strategy at Natix's Investment Managers. Mabruk, you got a sense that we have lots of tensions geopolitically, yet the VIX is nowhere to be found, and markets seem to be underpricing risk. How concerned are you about this?
Well, we used, as I used to say, don't fight a trend. If there is no concern on the market, it means that the market are, let's say, comfortable with the situation. They are not looking at this political and geopolitical risks so far. Maybe it is too far. We have the tariff and the U.S. election, which is another important moment for the market and on the calendar. But as I said, this is too far for the market to consider this risk as a concrete risk. And the other risk, we mentioned, the situation in Iran and in the Middle East from a global perspective. The situation in this part of the world is, of course, worrying and scaring, but definitely it's not a major contributor to, let's say, growth rate, to the global growth rate, and to the markets. So if we are cynical, and the market are cynical at some point, they don't pay attention to these risks because the situation is not, contributing enough to the market and to the contribution and to the creation of added value. So they are only looking at the most important topics, and the most important topics are the first one, the trade war, which is about, to restart because it has never ended actually. And the second one could be, also the situation in Europe, of course, because we still have a war between Ukraine and Russia.
Let's pick up on the trade war, the escalating trade war, and now we have the U.S. imposing more sanctions on China. Is China able to navigate all of that, and is Asia able to navigate all of that?
That's an excellent question, because China has already demonstrated that China is able to navigate in this situation, finding solutions to work around, the sanctions already imposed by the U.S. administration. We remember that Donald Trump and Joe Biden has already, imposed increased tariff on several products. And what happened then? China has used Mexico and other countries like Vietnam, for example, to, let's say, to export their product to the United States without, suffering from this tariff. So I would not be surprised, to see the Chinese administration being agile and finding solutions to work around this situation, this continuation, this escalation of the trade war. But now, the point is there are new players in this trade war. We have the European countries, and at some point, some emerging countries are also considering the idea of imposing tariffs to China to protect their own market. So the generalization of this trade war to other countries like Europe, like emerging countries, against China could be tough, because these workaround solutions could, at some point, no more be used by China to escape from this situation.
Let's talk about the potential in the Chinese market, because valuations are looking really, really cheap. But you say patience is essential when it comes to investing in China. How long do you want to be patient?
Well, why patience is key for when we look at the Chinese stock market. Of course, valuation are super low, and if we look at only valuation, it is the right moment to increase our exposure to this equity market. However, when we look at structural issues, when we look at the property market, for example, and the recent package decided by the Xi Jinping administration is not enough, to restore confidence. When we are foreign investors, what we need is visibility. We need visibility on the economy and on the market that we want to be exposed to. So definitely, I think the problem with China is a lack of visibility. If we compare, China and India, for example, India, we have, this visibility because we know that the growth is there. The situation is quite stable. So again, patience is key, and visibility is not there in China.
When it is time to invest in China, what would you be picking up? Would you be looking at consumer stocks, for instance, giving the rising middle class? What would be the basis? What would be the checklist for you?
I think when the confidence in China, the household's confidence will start to increase again and reach, the level that we used to see before the pandemic, I think this will be the right signal to be re-exposed to this stock market.
All right, Marbrook, great insights. Thank you. Do come back. Marbrook Chetwan of Natixis Investment Managers. Plenty more ahead. Keep it here with us. This is Bloomberg. Intel's CEO says the company is unveiling a new line of personal computers optimized for AI tasks. We spoke exclusively with Michael Dell alongside NVIDIA Chief Jensen Huang at the Dell World Conference in Las Vegas.
All our new PCs will be AI PCs, right? And the reason is that anything that you're doing that has an edit prompt is going to be sped up because every software developer in the world is figuring out how to use all this new power in the GPUs and the NPUs in these new AI PCs.
Neural processing units for the
exactly.
initiated.
So that experience will be better. So when your PC is now 4 years old, it's time for you to get a new one, right? You're going to want the one that speeds up those new capabilities. And inside your company, they're going to want to make sure you have that they don't want to buy a machine that's going to last for several years that doesn't have that capability.
Jensen, where is NVIDIA's place in the AI PC? I know you as gaming. That's, again, I grew up with the gaming side of NVIDIA.
Yeah.
Do you have a place in the AI PC market?
Come back next year.
Exactly. There are a bunch of NVIDIA GPUs and Dell PCs and Dell workstations. All of our GPUs have the same tensor cores that are running in H100s in the cloud. And so every one of our GPUs use AI to do its work. AI, of course, is going to transform gaming. All the NPCs, the non-player characters, they're going to be
Think
chatbots.
about development time, how it will be cut, for example.
Creating worlds is going to be easier. Instead of instruction-driven computing, it's now intention-driven computing. So it's easier to write programs. Python programs will be even easier to write. Video conferencing will be a lot better because of it. Yeah.
But what you did with Blackwell and other products is you innovated by saying, okay, let's combine GPU with CPU. Is that the next iteration for you in AI PC? You go, okay, here's the NVIDIA CPU that goes with it.
We want to support every CPU the world makes. And there are places that want x86, we support x86.
Yes.
There are places that prefer ARM, we support ARM. We just went to ISC, and the top most energy efficient supercomputers in the world are now powered by Grace hoppers. And so wherever it makes sense, we'll support the right CPUs.
Michael Dell and Jensen Huang speaking exclusively to Bloomberg's Ed Ludlow in Las Vegas. Well, in the markets, we're keeping track of EV stocks in particular. Li Auto posting its biggest drop since March 2022. That's on the back of first quarter sales missing analyst estimates. Deliveries of its first all-EV car fell short of its own targets. The company's first quarter net income coming in at 1.3 billion yuan. Analysts were looking for 1.6 billion yuan profit, and that's according to data compiled by Bloomberg. Li Auto is slumping 18%. We're also keeping an eye on cryptos in particular. Crypto prices have surged on signs of momentum towards U.S. approval of ETFs, investing directly in second largest token, Ether here. Ether currently up by more than 5%. Take a look at Wii Technology investment up a massive 13% as we speak. Of course, Ether rose almost 14% in U.S. trading, and that was the steepest advance since November 2022. Great day for cryptocurrency. Still ahead, a deep dive into event-driven investing with Pictet Asset Management. Hear why they're seeing a lot of opportunities here in Asia. This is Bloomberg. Welcome back. China markets just heading to lunch. CSI 300 index joining that sell-off here in Asia. CSI down about 0.4%. The Hang Seng also in negative territory. That stellar rally in Hong Kong stocks may be overdone if it's according to technicals. 14-day RSI for the Hang Seng gauge has stayed above 70. This is a level which indicates that the measure is in overbought territory for most of this month. Take a look where we are in terms of CSI 300 index, again in negative territory. In terms of the yuan, unchanged at 723.50. 55. And as China goes to lunch, Japan comes back from lunch break. Let's get the very latest from Avril Hong. Hey.
Yeah, we're just about coming back from the lunch break in Japan, and going into it, we saw how Japan, their stock benchmarks were the outliers on the day where Asia's stocks are really reeling from this Fed speak and also the unwinding of the commodity stock rally. It's still hanging on to the earlier gains, actually extending a little bit, about 0.2% stronger. But I also wanted to talk about bonds in Japan. Remember how the 10-year yesterday hit levels on the yields that we haven't seen since 2013. It's all about this narrative, that expectation that the BOJ will continue to hike rates, that it will reduce bond purchases, normalize its monetary policy, all very bearish for bonds. We're seeing across the curve this move, but none of that is actually helping dollar yen. This is a dollar story, of course, as US yields rise. Now let's flip the board, because I wanted to talk through what the movers in Japan's stock markets are today. It's the insurers that are helping to lift the broad gauges. And this is on the day where we got yesterday their earnings, which showed really solid forecasts. They announced share buybacks. They're also cutting some of their holdings in client companies. So all in efforts to help to boost shareholder value. So the likes of MS and AD rising double digits, Tokyo Marine also well in the green. Let's flip the board again, because we are just about ending the earnings season on the Nikkei 225. One more left to report later in the week. And all things considered, it's been a pretty stellar run. We've seen more positive surprises than negative ones. The financials have been lagging, though, so it will be interesting to see how the wage and the inflation story feeds into their earnings outlook. Has.
All right, Avril Hong, thank you. Now, event-driven investing is a strategy allowing investors to capitalize on change events for companies. These can be internal, such as a management-driven move, or external, such as a regulatory landscape change. Our next guest runs an event-driven Asia equity fund. The Pictet Total Return Lotus Fund is up about 4% this year and has outperformed its benchmark. Joining us from Hong Kong is Pictet's head of Asia Special Situations, John Withard. John, good to have you with us. We know that event-driven investing has a low correlation to market direction. So why should investors be paying attention to it?
Thanks for having me. Look, I think it's just important to understand in this environment that we're seeing that there are risks to the market direction in general. There are geopolitical risks in many places around the world, and event-driven investing is a way of, I guess, decorrelating from overall market moves. So the way we look at it and the way we express it to our investors and our clients is it's a way to protect from the market moves that may happen when adverse events happen.
So where do you see opportunities in Asia right now, and what's the basis of it?
So I think the focus on event-driven investing is very much been, as we've just seen from what Avril was talking about, Japan.
I mean, I usually
so there's a very strong impulse in Japan for shareholder return and corporate governance, and that is creating sustainable levels of alpha for investors in the space. So if you look at what we've seen at this just finished reporting season in Japan, we've seen around about 10 trillion yen of buybacks announced in Japan, which is obviously very strong. We've seen over 50% of companies have increased their dividend and their dividend payout ratio. So there is a lot happening in terms of corporate reform that's really driving a lot of change and creating opportunities for alpha. But as we've also mentioned, we're seeing very much an impulse for the same thing appearing in Korea as well. So we are seeing the Value Up program being discussed, being implemented slowly, and certainly seeing the green shoots of a very similar program happening in Korea as well. So that's something that we continue to watch. And then ultimately, China's the big one. China's the one that everybody wants to talk about. And in China, obviously, we're watching very closely what's happening with regards to the property market, with regards to the inventory destock story, and potential policy that we're seeing that hopefully supports the market going forward.
So when it comes to China, John, are you expecting more stimulus? Is that driving the optimism? And where will growth come from?
Look, it's a great question. I don't think we're expecting much more stimulus, but what we are expecting is, I guess, a more decisive policy response. So we have seen them now finally begin to address this issue of inventory oversupply. And I think that if we can see some kind of an impulse there to really tackle that in an effective way, then hopefully that would lead to an increase in sales prices and obviously volumes, which would then support the market in general, and then really see a lot of sentiment turn on the space, in particular with the developers.
In terms of IPO in China, do you see a pickup there? Do you see opportunities there? When might we see that?
Look, that's also a great question. I think the capital markets are a little bit challenged both in China and in Hong Kong, I think for different reasons. Obviously, there is a bit of a regulatory pushback on IPOs in China on the mainland at the moment. In Hong Kong, it's very much about sentiment. Hong Kong has always been a very sentiment-driven market, and at the moment, we're just in that phase where the market is repairing its sentiment. So, obviously great green shoots in regards to what we're seeing with the market direction, and certainly more people are talking about Hong Kong as a market than they were about 6 months ago, but we really need to see, I think, it sustain for those large investors to come back to show interest in the sort of long-term and medium-term thematics that we're seeing emerge, and then ultimately to invest in capital markets in that way.
John, earlier you talked about how Japan is looking pretty attractive as well. This is a market that's seeing a lot of activist activity. I'm just wondering if that changes the landscape for you.
Yeah, absolutely, it does, and it changes the landscape for all investors looking at Japan. So, as you're well aware, there was quite an important set of reforms that came into place in Japan at the beginning of this year that were put in place by the Tokyo Stock Exchange, just in regards to their price to book, ROE, etc. But this now effectively gives investors a dialogue that they can have with companies that is mandated by the exchange, and that's a very powerful tool that investors can take to companies and to managements. And what it is forcing now, it's forcing a dialogue between investors and companies that really wasn't there. So if you go back to, say, 2014 or before, Japan was a market where there was very, very limited activist activity. We're talking 8 to 10 activist situations in any given year. At the moment, in the universe that we track of this space, we see around about 130 live activist situations currently taking place in Japan. And obviously, we're coming into AGM season, so a very, very topical set of proposals to come this AGM season. So we're very excited, and we think this will continue. It will sustain. And the rapid pace of change that we've seen from Japan being such a sort of a quiet market in this space to now what is the world's second busiest activist market has been interesting. It's been encouraging, and the way that corporates themselves are reacting to these dialogues is also very encouraging. We are seeing those buybacks. We are seeing these reform agendas take place, and we are seeing value created, and that's really what gets us excited as event-driven investors.
But I guess, John, the question is really, how do you play Japan best?
So, from our perspective, look, there's a number of different ways you can play Japan, and certainly I would not advocate against being just purely long-only Japan. Certainly, the macroeconomic tailwinds that we're seeing there are very positive, and we're seeing money globally move into that market, both from a foreign direct investment perspective and also into their markets. But from our perspective, there is that real impulse for corporate change, and those companies are making their intentions known. They're having dialogues with investors, and that's where we're focused. So we're looking at those companies that are improving, both trying to target their own improvement on the ROE basis, PBR basis, or any other basis. That's where we're focusing on, because companies are really trying very hard at rates we've never seen before in Japan.
John, just one final question before we let you go. What is the most important signal for you as you make your investment decisions?
I think for us, it's levels of activity, and by that I mean levels of investment spending, capex, M&A is very important as well. All these things lead themselves to confidence, and confidence is what we need to see to have the market be confident that there's going to be more investment and more transactions, which is really where we ply our trade. So we've been very encouraged with what we've been seeing in regards to spending and capex and M&A volumes as well picking up, and so we think that going forward it's a great space to be in, and companies are changing and improving across the region. So again, very excited about what we're seeing.
It does feel that the market's Seeing overconfidence right now, John. John, with our Pictet Asset Management, thank you so much for that. And the Fed also, a key focus for markets. Cleveland Fed President Loretta Mester no longer thinks 3 rate cuts are appropriate for this year, given the recent U.S. economic data. She spoke to us exclusively on the sidelines of the Atlanta Fed's Financial Markets Conference in Florida.
The economy has performed stronger in the first, 3 months of the year than we probably had anticipated, than I had anticipated. At the same time, we saw that inflation progress stalled in the first 3 months. We did get a April CPI report, which was welcome news, but I think it's too soon to tell what path inflation's on, so we just need to collect more information on that. But we're seeing moderation on some of the real side of the economy. It's still a strong economy, but we are seeing the impact of the monetary policy that we put in place.
Well, do you reject the idea that financial conditions got loose and that's the reason the first 4 months of the year we saw inflation level out or go up a little bit?
Yeah, the markets are going to be the markets, right? They move up and down. I think the way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced between labor demand and labor supply, and so we're seeing that kind of work its way through. And that rebalancing is going to put downward pressure on inflation, I think, as things play out. It's just that we didn't see that in the first 3 months of the year, and we're just going to need to gather more evidence on what exact path inflation's on in order to sort of determine whether it's on that sustainable downward path to 2% that we're all looking for.
There's been some thought that because of the nature of changes in the economy, part of the Fed's problem is that monetary policy doesn't reach a lot of the areas that have been showing price increases. Do you think you have a broad enough anchor on the economy to bring it all down, or are there still going to be hot spots you have to deal with?
Well, I think a lot of things happened during the pandemic, and we're still seeing sort of those pandemic effects. I don't think we can conclude that monetary policy isn't having an effect as it used to, but the transmission mechanism is something that changes over time, and we'll have to monitor that in order to sort of calibrate policy to where the economy is and where it's going, balancing those risks to both sides of our mandate. And that's what we're in the process of doing now. We gather information, right? We look to see where the economy is at the moment, where it's headed, and then we calibrate our policy in order to reach both parts of our dual mandate. And really, frankly, in the first part of the year, what we saw was the risks that we were too restrictive have gone down. Last year people were worried about, the Fed may be getting too restrictive and therefore it's going to dampen the economy. Those risks went down. At the same time, the risks to inflation, I think, are tilted to the upside and remain so. And so that's the balancing that we have to do as we set policy going forward.
This is going to be your last time to vote on policy, right, and to put out a dot plot. Where's your dot going to be? How many moves?
Well, I haven't determined that yet. I was on the record before saying I was at the median, which was 3. The developments I've seen in the economy right now, I would not think that that's still appropriate because the inflation risks have moved up, given the progress on inflation that stalled out in the first quarter. And frankly, the real side is a little bit stronger than I anticipated.
All about the dots. Cleveland Fed President Loretta Mester speaking exclusively with Bloomberg's Michael McKee. Well, still ahead, our conversation with the CEO of India's largest steelmaker, JSW. We discuss their growth strategy after reporting a fourth quarter earnings miss. That's next. This is Bloomberg. Well, India is just coming online, joining the trading day here in Asia and also joining the sell-off in the region. The Sensex index currently down about 0.1% in the first minute of trade. Losses too for the other benchmarks, including the Nifty Bank index down 0.2%. Now, let's stay with India. Its largest steel maker has posted fourth quarter profit that slumped 64% from a year earlier. JSW Steel says this was due to an increase in overall expenses and a decline in prices for the alloy. Despite India's booming demand, the company says it was hit by a 6% drop in steel prices. Let's discuss the earnings outlook and growth strategy with JSW Steel's Joint MD and CEO, Jayan Acharya. Jayan, good to have you with us. Do you think this 64% drop in earnings and profit is a one-off, that you'll see a reversal in the coming quarter?
Yes. Very good morning. Yes, absolutely. The costs were up, primarily coking coal, in the quarter four, and we had a subdued steel price environment globally as well as in India, primarily because of low-priced imports which came into the country. That impacted the margins. However, the volume growth was still strong. Going into the full year, if you see our results, I think we did quite well. Our EBITDAs went up by 52%, and it was the second highest EBITDA at JSW Steel. We are seeing a very strong economic momentum in India, and that will improve the steel demand going forward into the next year as well.
Let's break it down. Jayant, you talk about steel demand going forward. You're optimistic about it. What kind of demand? Give us a sense of, in terms of numbers, quantify that for us, please.
Yes. So India last year had a demand of 136 million tons, which was a growth of 13.6%, incrementally 16 million tons in terms of volume. Even in this year, although there is an election, so the activity has slowed down in the first quarter a bit, but post-election, post the budget, we expect it to come back to a growth trajectory. So even if you take about 9 to 10% growth, we see incrementally 12 to 13 million tons of steel demand this year as well. From a meeting the demand perspective, JSW Steel has added capacity. Currently, we are just commissioning our 5 million ton steel plant in Vijayanagar. The hot strip mill is already commissioned. Our phase 2 expansions in one of our plants has been completed. Overall, we'll be adding about 8 million tons of capacity over the year, but the full impact of that would come in this year and partly in the next year.
You got hit by steel prices, the low steel prices. What assumptions are you making about steel prices going forward?
Steel prices have stabilized. In the last quarter, it dropped quite a bit internationally as well as in the domestic market. It has bottomed out. We have seen a price increase of about $20 internationally, and that's reflected in India as well. So April and May has seen a price environment stability. We expect the prices to be stable. We expect the coking coal cost in this quarter, they're going down, so they would impact the margins positively. And our operating efficiencies on the back of some cost-saving projects which we have undertaken will help the margins. So we see a better FY25 with respect to volume, absolute EBITDA, and per ton EBITDA will normalize back to where we were prior to this last quarter.
We know that you're concerned about steel imports. Might that impact prices?
Yeah, steel imports is a concern, especially China, because of a weaker domestic market, has been exporting large quantities. Even in the last quarter, they exported about 26 million tons. India had a large chunk of that import coming in. So we are concerned at large, and I think there are steps which we need to take if this kind of volatile environment continues. We will watch it carefully, and we hope that the improving steps which China is taking would improve the domestic demand and exports will moderate as we go into the year.
Jayant, talk to us about coking coal. What's your procurement strategy right now?
So coking coal, we are importing coking coal from various countries internationally. We are in the process of improving our raw material security on coking coal. So we have acquired some domestic mines, which we are trying to operationalize. That would give us about 2 million tons of coking coal. We have recently, just a few days back, taken a stake in Mozambique in a hard coking coal mine, which is a very high PLV grade coking coal. The asset has about 800 million tons of coking coal. It's a good asset, logistically close. We expect that to provide a lot of raw material security for our Indian expansions. And going forward, we will continue to look for assets which are strategically and commercially viable on the coking coal side.
Right. And in terms of coking coal, are you buying from Russia? And if you are, what is the mode of payment?
So coking coal, we are not right now procuring, but we have been procuring some different kind of coals. They are the Corex coal, which we have been procuring from Russia for many years. In a typical steel operation, you need to basically develop the sources over time. So that continues, but that's again not a very substantial quantities. Our main coking coal comes from Australia, US, and Canada.
You talked about how you made the acquisition of Mozambique and exploring elsewhere. Where are some of these assets? What might you be interested in, and are you in talks currently?
Yeah, we have been looking at various assets, and primarily the hard coking coal asset, the PLV coal, which has been a very volatile in terms of cost. So those assets, we have looked at Canada, we have looked at Australia, we have looked at Mozambique, and Mozambique is one of the very few large coking coal assets which are still there in the world. We would like to develop these mines once the customary approvals are in place. We are hopeful that this will be a very good asset for us. We are looking at some operational mines in some parts of the world. If those strategically fit us, we'll look at it. Parallelly, we are looking at the domestic coal as well, and 2 million tons from 3 coking coal mines which we have got will develop. I think those will get developed over the next 2 years or so, and that would play into our overall coking coal requirement in India.
Jayan, a lot of Indian companies are formulating their decarbonization plan. What is yours?
So, yeah, happy that you asked the question. You know, we are in the leadership band by CDP in the sustainability index. On the water, we've got rating A, which I think is the only steel company in the world to get. We have also launched a SEED program, which got a COP28 award. The SEED program primarily aims at improving operational efficiencies at ground across all the locations. We will be saving about 18 million tons of CO2 emissions over the next 7 years, and that's been a very good program. We are already running a CCU, carbon capture and use, of 100 tons per day at one of our locations, and we are trying to see how we can expand those. We have started construction of the hydrogen plant at our Vijayanagar steel plant, and we would test how this works. And as the technology evolves and commercially becomes viable, we'll improve on that as well.
Jayan, thank you so much for your time today. Jayan Acharya, JSW Steel. Plenty more ahead. Keep it here with us. This is Bloomberg. All right, in the markets, we're keeping an eye on commodities in particular after that massive rally, especially for copper in excess of 11,000, now easing after that move that we saw yesterday. Cautioning its rally may have been running ahead of weak physical fundamentals. Copper futures currently down 0.5%. Iron ore also lower right now. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. This is Bloomberg.